I think it's one of the tools that has a chance to, right? So I think that, and that's where we go back to, true hyperinflations or truly impoverished areas. Having access to liquid hard assets is really useful. Anyone paying attention to what happens in Venezuela, Turkey, Lebanon, any of these countries, Eastern Ukraine, where people are trying to flee out of that area, right? Having self-custodied hard money is really useful. And I think that's one of the things that people in the West missed or don't care about, is they think like, why do we need crypto? Why do we need Bitcoin? And it's like, well, you spent decades in a rather safe bubble that the majority of the world doesn't have access to. Most people, a lot of them don't even have access to good stock markets. A lot of them don't have, a lot of people can't afford a home. And so they need something hard to save in that's liquid. And it's volatile. One of the long-term potentials is that Bitcoin can be that thing. It can allow for uncensorable payments, and it can allow for difficult to confiscate savings. And so I do think that that's one of the technologies that can, demonetize. We've monetized all these assets like homes. Ideally, you want to demonetize these productive things and have actual money be monetized, right? Instead of bad money and then monetize everything else, you demonetize those things and have your actual money stored in money. And so I do think that's one of the most powerful tools that people have. Wealth concentration is a lot more complex than a lot of people make out to be. They often propose that there's just one thing. Like if we didn't have QE, then we wouldn't have wealth inequality, for example. Or I prefer the term wealth concentration usually, just because no one should expect wealth to be equal. It's only concerning when wealth is say unhealthily concentrated due to kind of bad policies, right? So I kind of tend to phrase it as a problem of wealth concentration, and I think that the big starting point is to make that it's there's so many moving parts, and some of it is unintuitive to a lot of the common narratives or sound bites that you hear, both inside the Bitcoin community and in the broader macro community. There's so many kind of takes out there that aren't necessarily backed up by data, and the actual underlying, all the mechanisms are actually really complex. Bitcoin as a type of populism, but I would just describe it as one of the better types of populism. Basically, it's people rallying behind a new network effect technology and saying that this is the solution. And so that's obviously the populism I would prefer, more so than some of these kind of other types of populism, right? So I think that I don't view populism in itself as a bad thing. I just view it as something that it starts, you have to, when it starts to develop, politicians have to pay attention to it. And if they don't, then you start to get these more dangerous varieties. Absolutely. And part of it, that goes back to Bitcoin and money, is that because we've had decades of bad money, weak money, right? So zero, near zero interest rates, and especially negative real interest rates, people have had to monetize other things. So they monetize stocks, they monetize real estate, they monetize all these other types of assets. And those, especially for real estate, which is among the most functional of assets, it puts them out of the reach of people. So if you look at, say, home values to income ratios, and this is not just America, this is around the world, it put that more out of the reach of people. My father, who he was pretty old when I was born. He was old enough he could have been my grandfather. And when he was like in his 20s, he was a police officer and he just bought a house. Like it wasn't a huge deal to buy a house. Whereas, decades later, someone who and he didn't have to get student debt to do that. He just kind of went in and worked and was able to buy a house. And now we've kind of made it so that, you need a degree often to have kind of a similar income that someone had decades ago without a degree. And yet you also have student loans and things are more expensive. And so that's kind of part of why people have kind of sensed that things are becoming more and more stacked against them. Absolutely. If you look at, so I've used kind of the 40s as my template for where we are in the 2020s. But if you look at the 2000s and the 2010s, that means those were the 1920s and 1930s. You kind of have this big parallel, and you can frame that in multiple ways. I like to frame it through the long-term debt cycle, right? So that's the last time that monetary and fiscal policy look like it does now. But it also looks very similar in terms of wealth concentration. That's the last time you had wealth this concentrated in the US and in some other countries. And yeah, you get prone to extremes, right? So you have kind of a spectrum of outcomes. On one hand, you can have like what happened in Russia, where you overthrow, the wealthy and then make it worse, right? You just kind of have that kind of revolution. You also, in another dark way, you have like the Nazis, right? You had the rise of that was one of the most dangerous forms of populism at the time. Or in the United States, we because of our experience with World War One, we then did World War II a little differently, in the sense that when say veterans came back from World War One, we kind of just gave them a bus ticket and said thanks for your service. And then that led into some of the things that the wealth concentration that happened throughout the 20s, and eventually, kind of the breaking of the social contract. Whereas when we had veterans come back after World War II, we were like, okay, I mean, this is not where we're going to stop spending money now. So we're at least going to make sure that these veterans have resources to get integrated back into society, that we thank them for their service. And so we handle, obviously there's, different political opinions about the political leaders at the time, but we did kind of recognize that there was growing sympathy with communism in the country, right? There was, we were kind of in that kind of war of ideas with the Soviet Union, with kind of the more those more dangerous aspects, and we said, okay, we don't want to go down that route, but we can't ignore some of these rising populist tendencies and these people noticing that the social contract's breaking down. So it's okay, how can we tweak policy to kind of address that? And right or wrong, they kind of threaded the needle enough that the United States kind of, partly because of the war outcome, but also just because we kept our kind of institutions relatively intact, we went on to have another several decades of prosperity. So it kind of is identifying the problems and then not ignoring them, right? But there's obviously different views on the best ways to solve those. I think it depends on where in history you are. If we imagine a sufficiently technical future where, say, 80% of the population just can't find a job, that's a very different discussion than what we have, say, right now, right? So I think, I think when you look far enough in the future, those types of things, I don't think someone's crazy for bringing those up and say, how are we going to manage this if we get to that future? And I know Andrew Yang likes to use he uses the example of Alaska, right? Because he likes to point out that it's not purely a left-leaning thing, right? So Alaska is a generally Republican state, and they had like an oil dividend to their people, basically that the people of Alaska in some way benefited from the fact that Alaska has oil, rather than just a couple companies coming out and them benefiting from it. Norway did a similar thing where they had these gigantic oil reserves, right? And instead of just having a company come in and just kind of get all the benefits, they said, no, this is the people of Norway's resources. And so they that's how they started their whole $1 trillion sovereign wealth fund. They started with oil profits, and they took those profits, they invested it. So now people in Norway have the equivalent of a gigantic pension.
I've decided to do just to make separate videos, right? One on geopolitical risk trading as a broad overview, and then one on my specific market activity from this past week. And so this one is the former of the two. I will say, however, that this week, I traded bonds, crude, equities, FX. Overall, I knocked it out of the park. But more importantly, just being right for the right reasons. Okay, now, with that said, trading geopolitical risk and headlines and themes. This is something of I don't want to call it a specialty of mine, but by default, a specialty of mine. By which I mean, so whereas most people try to distance themselves from kind of geopolitical risk headlines and their market activity, but while most people do that, I actively or proactively dive in and been doing so for years. It just simply means that I have a lengthy history of taking many shots on goal across many different kinds of events and headlines, trades, asset classes, time horizons, strategies, objectives, and so on. So I've built up a pretty good record, or a track record. And I've also built up somewhat of a reputation amongst some hedge funds who I would often talk to, or who would often talk to me about whatever may be going on in the geopolitical risk arena and markets over the years. So with that said, let me just show you a clip This is from the Real Vision Daily Briefing from October 2nd, 2020.
How and why? But that's it's a fantastic post, and I don't want to go on about the exchange, but a guy called Weston, who's in Tokyo, an ex-Goldman guy, who's really prolific on the exchange, super smart.
Yeah.
He did a video post on how to trade geopolitical or headlines. And he talks through how the professionals do this and how not to fall in the trap. Brilliant. If anybody wants to watch it, you'll get a ton of learning from him about what to do in these situations. Part of his thing is you need to go through all of the opens and closes of all of the globals. So you need to go through the Tokyo Open and close, the European Open and close, the US Open and close, and then back to the Open to let all the market on close orders and market on open orders clear through. Then you'll see the actual underlying, and then also how to approach something which has some politics behind it, which is this Trump headline, and try to become a machine in how you analyze it. You need to analyze it without your political lens, which most people always end up putting their own political lens on. It's a really good post. I was really impressed.
Trading geopolitical risk is really, really, really hard. By which I mean not the geopolitical risk part, but that first word, the trading part. In other words, what I'm saying is trading is really, really, really hard. It doesn't matter if it's geopolitical risk or earnings or whatever. It's all hard all the same. And it's because there's like two elements to everything, right? There's the understanding and like the forecasting of the real world event, whatever that is, which is pretty much impossible to do because that's basically, you have to tell the future, if you will. And the other part is getting the market call right? So you have to get those two things like simultaneously correct. But that's also why I'm just classifying this as just another part of trading. There is no like subcategory of geopolitical risk trading that's any different from fundamental earnings based trading or event driven trading or whatever else it may be, because that's based on some sort of like real world fundamental thing. Markets can behave and react in any way if they do at all to whatever sort of fundamental thing that's happening in the real world, right? Markets don't care about how many people died or pain and suffering from war or natural disaster or tragedy or so on. They just don't care. And of course I have my own personal views about things. But if I were any bit good at what I do, which I think I am, you would never know what the things that I care about are personally. Is that you have to get the real world event right? But you really have to get the market response part right. Okay, so who cares if you made a call about some number that some investor relations department releases once a quarter, or how some central bank board voted? Who cares if you get those things, correct, that number guessing game correct, if you get the market reaction part completely wrong? But you need to get both of those things simultaneously correct. And so that's what makes, trading geopolitical risk extremely difficult, if not pretty much impossible. And it's not because of the geopolitical risk part, it's because of the trading part of it. If you're trying to pull something right now, like if you're a company or whatever, now is the time for you to do so. You could bury things under the rug right now. And that's where risk is going to be. And that's where opportunity is going to be, where the cameras are not. Right? The things that could come out of left field. That's where you want to look. And then my final general principle is the following. If you're ever surprised by anything that hits the news or anything that, happens, any developments, if you're ever surprised or shocked or catches you off guard, that is not your trade. Do not trade that. Especially, immediately, but just do not trade that. Only trade what you've already either anticipated or given some thought to, and then comes to fruition. Don't be surprised and then chase something, because you're getting into a market scenario that you haven't thought through and that you just dove into, and now you have involved yourself and your capital with. And so I want to leave you with this clip that I have. It's of Lloyd Blankfein, who was the former CEO, chairman CEO of Goldman Sachs. He was on Charlie Rose. This is a few years after the financial crisis, and he had sort of emerged. And this exchange that they have, I watched this at the time, and it really, really stuck with me.
How far out into the future do you think you can see?
Well, I'm in the risk management business, so I don't take it for granted that I can see behind. I don't think I can see 4 inches into the future. Yeah. I'd say that most of my...
But your firm has a reputation of being pretty good at understanding the future and being able to make some analysis as to about what risk to take.
Well, I'll confess to you that what I think we aspire to is less foresee the future and more be a great contingency planner. And sometimes if you contingency plan really well and you can respond very fast to what's happening because you thought through all the possibilities, you can get off the mark so quickly it looks like you false started. It looks like you anticipated the start when all you've really done was listen so closely and knew what you were going to do that you got off the mark quickly. I think it's hard enough to predict the present. Think about it, perspective. It's very hard to step out of your context and see what is happening. I have views about the future, but I'll tell you, we're not in the business. You wouldn't be a very good risk manager if you let what you think was going to happen have too great an influence on what you plan for and protect it against. What we really do is we really contingency plan. What might happen, what could happen.